Well, welcome back to the podcast. Today, we are going to talk about the last part of 2025, as well as what Wall Street expects for the stock market in 2026. Because as we head into 2026, investors are asking an all too familiar question: can the stock market keep going, or are we finally due for a pullback? And so we're going to talk about what has happened and what will happen, at least what a lot of the big financial firms are saying that they think is going to happen. But most importantly, like I said, what that means for you as an investor, especially if you are approaching or already in retirement. All right. So first off, let's go over third quarter GDP. Thanks to the government shutdown in October and November, we didn't get a chance to look at the third quarter GDP numbers until partway through December. The Atlanta Fed GDP Now indicator was calling for a 3.6% annualized growth, which in itself would have been a significant number. But the 4.3% growth that was actually reported was nothing short of astounding. There were all sorts of talk ahead of the report that the consumer was spent, that confidence was in the tank, and that tariffs would finally begin to erode growth as inflation returned. And if that's all true, could you imagine what the GDP would look like if the consumer started spending and confidence returned? Oh, wait, the consumer is spending. If you look at the recent holiday season that we just had, and confidence is beginning to return thanks to the lower than expected consumer price index readings. And many people can begin to feel hopeful once again. So first off, let's talk about tariffs. Tariffs, which have been a go-to argument for some who are expecting inflation to return, haven't seemed to hurt GDP and don't seem to have made a dent in consumer spending during the holiday season. There's also constant negativity from the media telling us that prices will rise anytime now, and letting us know how miserable we all should be. But we're actually seeing is crowded parking lots, sold out shelves, and gas now averaging under $3 a gallon nationwide. Not to mention the 4.3% GDP that we just saw in the third quarter. Now, some are saying the fourth quarter GDP might be muted because of the government shutdown, with predictions around 3%. But just because government workers stayed home doesn't mean that they didn't spend money. We're going to buck the trend and say that we're going to see another big GDP print for the fourth quarter. And I mean, who wouldn't want a strong GDP growth as compared to the alternative, right? Not me. So also the S&P continued to climb towards 7,000, closed just over 70 points shy of that milestone there. And even though closing early on Christmas Eve and staying closed through Christmas, the S&P managed to notch 3 more record highs and then just missed out on another record high on that Friday. Now, is that 7,000 number, is that important? Well, ultimately not really. I mean, we're probably better off focusing on the fact that we will have had 3 straight years of double-digit returns, but 7,000 on the S&P 500 is a milestone, and milestones makes feel good, right? Will it make a difference in your portfolio? Not really, but it will make people feel like we accomplished something more this year. The Santa rally paused for a bit, but then there was a real possibility of hitting 7,000 in the final 3 trading days of the year. So good end to the year, basically. And so that was good. If you were here with me when I made my initial prediction of where I thought 2025 was going to go, I did not feel like it was going to have quite the growth that 2023 and 2024 saw, but we would probably be up somewhere in the range of like between 10 and 15%. And we ended up just a little bit north of that. And so still did not see what we saw in 23 and 24. So I was right in line with my predictions. Now we're going to talk a little bit about 2026 now, and I'm pulling these insights from a few different major perspectives, and the links are going to be all in the sources here. And what's interesting about these different sources that I have looked at, they all think the market can still go higher, but they just don't agree on how smooth the ride's going to be. And so let's break it down. All right. First off, let's start with the optimistic narrative because there is plenty of it. The first big theme is continued economic resilience. According to several analysts, the U.S. economy has proven far more durable than expected, even after years of high interest rates, inflation scares, and geopolitical tensions. We've got some stuff from CNN. Their market outlook leans into that idea. Corporate earnings are still growing. Consumer spending has not collapsed, and businesses continue to invest aggressively. There's even some comparison being made to the 1990s expansion, where productivity gains helped fuel a longer than expected bull market. Another important bullish point: market breadth is improving. In recent years, a handful of mega cap tech stocks dominated returns, but now we're seeing the Dow outperforming the NASDAQ at times, value and industrial names participating, and a broader group of companies contributing to the gains. And that's usually a healthier sign for the markets. And finally, there's the expectation that interest rates eventually will be coming down even further, which historically supports higher stock valuations. So on the surface, the story sounds pretty good, right? But as always, it's not the whole picture. So if there's one word that could that could sum up every 2026 outlook, it's AI. Bloomberg analyzed hundreds of forecasts from major banks, asset managers, investment firms, and AI consistently came up as one of the primary growth drivers. Here's the bullish argument. Massive capital spending on AI infrastructure has been going on. Productivity gains across industries because of it, and strong earnings growth for companies that are implementing AI efficiently. And in other words, it's not just a tech story. It's being framed as a structural economic shift, similar to the internet or mobile revolutions. Even CNN echoed that view, suggesting that AI-driven earnings growth could justify today's higher valuations. However, Bloomberg also introduces a note of caution. Returns may be concentrated in a smaller group of winners. Not every company that says AI is going to benefit. Valuation risk could increase if expectations get too high. It's not dissimilar to when you think of a different industry. Just because a company is in that industry, that does not mean that that company is going to succeed. How many electric car companies can you name right now? Most people are like Tesla and Tesla. It's pretty much it. That's what most people can name. When I say electric, I mean entirely electric. I'm not talking about those that might have a hybrid or something like that. We're talking electric car company, and Tesla is pretty much about the only one that most people can come up with. And so there were a lot of electric car companies that have tried, but there's not a whole lot that have succeeded. And so we need to have that same type of cautionistic optimism, cautionistic, did I just make up a new word? Cautionary optimism with AI as well. So it might be concentrated within a small group of winners, not the entire. Just don't throw money at something just because it says AI. All right. That would be a piece of advice. That's not a recommendation, by the way. It's not a recommendation, but you might want to be cautious. And again, Charles Schwab perspective, they stand out a little bit because they don't necessarily disagree that markets can rise, but they're framing 2026 as a year of instability, not necessarily clarity. And their view is essentially also that markets can still climb, but it may feel uncomfortable the entire way up. And so the main risks that Schwab is going to highlight is inflation is not fully gone. I mean, even if inflation is a lot lower than its peak, it's not completely tamed. And that means the Fed may cut rates slower than what investors hope. Interest rate volatility could still remain a little bit of a risk. Tariffs and policy uncertainty. So trade policy, tariffs, global tensions, those could still raise costs for companies. I mean, just because it hasn't happened to the levels that we have thought yet doesn't mean it couldn't. And so those could raise the costs. They could compress some profit margins and create unpredictable earning surprises as a result of that. And so we should be expecting more volatility, not less. Schwab does expect sharper pullbacks, faster rotations between sectors, and a market that rewards active decision-making over passive complacency. And so while CNN emphasizes growth and Bloomberg balances optimism with risk, Schwab kind of leans more into the idea that 2026 won't feel easy even if the returns end up being positive. So they're taking more of the pessimistic look out of some of these that we looked at. And so let's quickly summarize the consensuses and the conflict. Where they agree, stocks can go higher in 2026. Definitely agree. AI is a major economic and market force. Agreed. Earnings growth matters more than hype. Also agreed. I'm going to say this right now. I've said it many times that even when it comes to politics, I'm registered independent. So I don't care about the politician or the party. I care about the policies and how that affects the portfolios and the pocketbooks of my clients. And when the news starts getting noisy, go to the numbers. That would be that bullet point right there. Earnings growth matters more than hype. Way too much hype out there. Follow the numbers. And also, the Fed is still going to play a critical role. So that's where they all agree. Stocks can go higher. AI is a major economic market force. Earnings growth matters more than hype. And the Fed still plays a critical role. Where they disagree is how smooth the ride is going to be. CNN, optimistic and growth focused. Bloomberg, optimistic but risk aware. Schwab, cautious and volatility focused. So that's kind of how they're seeing things. And how broad market gains will be. CNN sees improving breadth. Bloomberg worries about concentration, and Schwab expects constant rotation. So, yeah. So finally, though, what does this mean for you, the investor? Here's the key takeaway, especially if you're within 5 to 10 years in retirement. The biggest risk in 2026 may not be missing returns. It may be assuming that the market will behave the way it has behaved for the past few years. And this environment favors diversification, risk management, realistic return expectations, and a plan that doesn't rely on perfect timing. Matter of fact, no plan should really rely on perfect timing. All right. If markets go higher, but with more volatility, the question is going to become, can your portfolio handle the bumps without forcing bad decisions? Right. And we believe that we have structured people's portfolios to where they can handle the bumps without forcing bad decisions. And that matters far more than predicting the exact direction of the S&P 500 at any given time. So again, this is going to go back to the plan and the fact that we take into account that there will be drawdowns, there will be volatility. And so we've got things set up to where hopefully we are able to mitigate or maybe lower some of that volatility so that those knee-jerk emotional reactions don't end up happening. Even if the news is noisy, that doesn't necessarily mean that that's actually what's happening inside your portfolio. And so obviously, as 2026 plays out, if there's anything that happens that does cause you concern, just simply reach out. Most of the time, it's a very quick conversation about the realities of what is actually going on within your portfolios, and which might be different than what the actual news is talking about. So feel free to reach out. So yes, 2026 could be another positive year for stocks, but optimism without preparation is speculation. The real opportunity is making sure that your portfolio can participate in growth without being derailed by the volatility. And so if you found this helpful, thanks for listening. Make sure to send this on to a friend or something like that if they might have some of the same concerns about 2026. And so again, looking forward to this. One last little cautionary tale, and it doesn't have anything to do with what I was reading on CNN, Bloomberg, or Schwab on this one, but also going into the fact that we have just come off of, this would be my last little cautionary plug, I guess. I'm still optimistic, but maybe I'm a little bit more like Schwab on here, is I do think the market is going up, but I would be cautionary because if we look back historically, the stock market is usually up on average about 3 out of 4 years. And so we've just had 3 years of growth, actually double-digit growth. And now we're coming upon a 4th year. Not only that, if we also equate those 3 out of 4 years of the market is up, meaning 1 year it's down, if we equate that to a presidential term, that means that 1 year out of a president's term is normally down. And historically, that has tended to be the sophomore year of a president's term. If we think about 2018, for Trump's first term, and then 2022 for Biden's term. Well, we're coming up on the second year of Trump's second term now. And so that's another reason that I may think that there could be some volatility and possibly even negatives. I don't see any economic reasons right now why there would be negatives. But if we're just following that, trend, then that would be one of the reasons that we might be able to see that next year, and anything, black swans or whatever could end up happening, stuff that we don't see coming. But again, from an economic standpoint, signs point to where next year should be a positive year. So hopefully we get that across. It's not going to be a straight shot. There are still things that can mess with that, but ultimately we do think it should. Now, if that changes, we'll definitely let you know. Again, thanks for listening, guys. And as always, we're trying to give you the type of information to empower you to live the retirement you deserve. Take care. Have a great week.